So conceptually, here's what happened for the miner to unlock the block. The miner has the blockchain downloaded to his or her computer, plus a mining hardware machine. The miner then monitors the memory pool of transactions for verified but unconfirmed transactions, and groups them into a candidate block. All of the transactions are then hashed together through a Merkle tree to arrive at the Merkle root hash for the candidate block. Then the mining hardware takes the previous block header hash and the Merkle root hash and a nonce figure that it constantly changes for millions, billions, trillions of trial and error hashing computations until it uses a nonce figure that results in the correct target hash with 19 leading zeros. A now very happy miner sends the block hash and nonce as his or her proof of work to the other miners so they themselves can test it and determine whether or not the broadcasted nonce results in the broadcasted hash and that the hash meets the target requirement of leading zeros. An easily identifiable proof of work to prove that the miner's hardware equipment did all the necessary computations to crack the code. The candidate block then becomes confirmed to the blockchain, and all of its transactions are officially processed and added to the blockchain. The block or data file is then distributed to all the nodes so that it becomes an official part of the blockchain. Now, this block will be used by all the nodes, in addition to all the previous blocks, to verify future transactions. And there you have it. That is the blockchain compound explained in full. The full process explaining how a wallet creates private and public keys, how it creates a digital signature that accompanies every transaction, how the nodes verify unspent outputs and decrypt the signature using the public key, and how the miners add transactions to candidate blocks, then perform computations to unlock a block and confirm it to the blockchain. But we haven't yet covered why the miners even mine in the first place, which is a major part of the mining process and a major part of Bitcoin's value. Let's revisit block 679,750 so you can easily see why miners mine Bitcoin. Miners are incentivized to help facilitate and secure the network for three main reasons. In no order they are: number one, because they love Bitcoin and the macroeconomic and socioeconomic implications of a decentralized currency; number two, the block reward; and number three, the fee reward. First, let's discuss the block reward. The first transaction of every block is called the Coinbase transaction, which is the blockchain's way of not only incentivizing miners to mine blocks, but it's also how new Bitcoin is created and added to the network. The Coinbase transaction is literally the miner's reward for his or her machine being able to compute the correct hash to confirm a block. Remember I called it a lottery? Well, this is why. The Coinbase transaction consists of the block reward, which is brand new Bitcoin created through the unlocking of the block, plus the sum of all fees included in the transactions of the block. In terms of the Coinbase block reward, this is why mining is called mining in the first place, to compare it to mining for precious metals and the act of finding new units. It's important to note that the Coinbase transaction is the only transaction in every block that doesn't require an input address, only outputs. Since nobody is sending this Coinbase transaction to the miner, it's as if the blockchain is sending these newly minted coins to the miner. So there's no input other than Coinbase. The new coins are the input, but they're not from an unspent address like every other transaction requires. As for the fees, those are the Bitcoin users' contributions to the miners for facilitating the network. Miners actually handpick which transactions they include in their candidate blocks, and each transaction has some small fee included from the sender. Naturally, miners are more inclined to include transactions with higher fees attached. Therefore, Bitcoin users can incentivize miners to include their transactions in their blocks by increasing the fee for the transaction, thereby confirming and processing it faster. This screenshot is from the same block 679,750, but at the transaction level. You'll see each transaction has a summary hash, timestamp, input and output addresses, and amounts, plus a fee paid in Bitcoin. At the time of this block being confirmed, Bitcoin was about $55,000 per coin. So the first transaction fee of 0.00069,383 Bitcoin equals about $38 to send 0.0125269.3 Bitcoin, or about $688. That is a high fee, but it was chosen by the sender or by the sender's wallet. The next transaction, for instance, sent about $2,600 worth of Bitcoin and paid about that same $38 in fees. Some of these fees plus the block reward totals together for the Coinbase transaction and is sent to the miner's wallet. Then the lottery or competition continues and the next block is unlocked the same way, and the next one and the next one, creating a chain of blocks linked together and secured through advanced math, cryptography, computer science, and hashing. One final very important concept to cover is Bitcoin's maximum supply and how it will be achieved. There is a maximum supply of 21 million Bitcoins to ever be made. After 21 million Bitcoins have been mined, there will be no new Bitcoin created. To ensure that there will always be value in Bitcoin, scarcity was built into it. This does not mean that after the last coin is mined, that Bitcoin will go away and that you can't send or receive Bitcoin. It just means the block reward in the Coinbase transaction will equal 0 instead of being a value to the miner. This scarcity and maximum supply is possible because of Bitcoin's halvings of the block reward. With the passing of every 210,000 blocks, or average of every 4 years, the block reward that miners receive gets cut in half. It began with 50 coins as the reward, then was cut in half to 25 in year 2012, then down to 12.5 in year 2016, and the most recent halving was in 2020, taking the block reward down to single digits for the first time ever. If you recall from our previous example, block 679,750, the block reward in the Coinbase transaction was 6.25 Bitcoin. If you use the Blockchain Explorer to view historical blocks, you'll see that the block rewards were consistent with the halving schedule. Block 500,000 was mined in 2017, and the block reward is 12.5 Bitcoin. Block 250,000 was mined in 2013 with a block reward of 25 Bitcoin. Lastly, the first ever block was mined in 2009 with a block reward of 50 Bitcoin. Eventually, as the reward continues to get cut in half, it will dwindle down to 0. At that point, the fee reward will be the primary financial incentive for miners to help facilitate the network. And here is the full halving schedule until the last coin is expected to be mined around year 2140. And with that, my Bitcoin blockchain explained lesson is finally complete. From the wallet software with elliptic curves, public keys and private keys, to the verification process with unspent outputs and digital signatures, to mining, to nodes, to the block reward, to the halving schedule, I've pretty much touched everything surface level that you need to know to be a comfortable Bitcoin investor. You now